Hello everyone, welcome to Within the Frame. I'm Kim Bo-kyung. Washington's consumer prices have been announced and are hotter than expected. Investors have scaled back bets that the Fed will begin cutting rate as early as May. Meanwhile, South Korea's inflation is slowly being tamed. However, uncertainties from the Middle East region linger. And now that the U.S. is not expected to cut rates any sooner due to sticky inflation, the Bank of Korea faces a dilemma over the rate-setting decision. Today, Within the Frame aims to ask experts about what would be on BOK's mind and, if time allows, how Korean Air and Asiana are just one step away from forming a mega carrier after the EU regulator's recent approval. For this, we invite Professor Kim Sei-wan from Ewha Womans University. Professor Kim Sei-wan, welcome.
Good evening.
And we also have Professor Hwagyun Kim from the Mays Business School at Texas A&M University. Good to see you again, Professor Kim.
Good to see you again.
All right, Professor Sei-wan. So U.S. CPI has been released, showing it rose by 3.1% in January. Now, inflation did cool down, but the figure was higher than expected. How did you see the data?
Well, it is true that U.S. inflation pressure is weakened over the last 12 months. The first half of last year's U.S. inflation stayed at 6% level or near, but it decreased down to only a 3% level recently. But January's increase in prices was the largest in 4 months and occurred against the backdrop of labor market strength and economic resilience. In January, U.S. consumer price rose more than expected amid a surge in the cost of rental housing. Particularly, the rental housing cost accounted for more than 2/3 of the rise in January's CPI. But I would say that this month's higher than expected inflation could be a temporary rise. We see some seasonality, which is economic jargon actually, in January's inflation, because January is typically a strong month for inflation readings as businesses pushed through prices increases at the start of the year. So to summarize, U.S. inflation is slowing, but probably not fast enough to encourage a Federal Reserve to start easing rates soon.
All right, I see. Well, it is indeed a relief to hear that this is going to be a temporary, phenomenon. But Professor Hwagyun, with inflation and pressure not easing off that easily, the Fed was widely expected not to begin rate cuts in May. However, new data today suggests that retail sales fell 0.8% in January, much lower than expected. So, based on all of this, what decision do you believe Fed will make?
I mean, at this stage, everybody seems to be gathering more information and try to get some more clues. So it's time of uncertainty, I believe. So even in terms of the inflation expectations, I looked at multiple sources, and one of them actually was about 2.9%. And lots of media, including Wall Street Journal and New York Times, used this to quote that it's actually hotter than expected because actual inflation was around 3.1%. But if you looked at all the different sources of forecast, it was kind of rather wide in terms of range from like 2.4% to 3.5%. So clearly higher dispersion in forecast means there's more uncertainty in information. So the new data release that you just talked about gives some extra points of data that, maybe, it's not going to be just that late because the economy is cooling down probably, but still it's just one more data points and people have to see and wait. And according to the Fed Watch data, that's kind of showing the expectations and distribution based on the Fed futures. In May, about 35% chance of lowering the interest rates. And in June, it's about 65%, and then in July, about 90%. So it was a bit higher in March, but now I think it's almost close to like 5% to 10%. So most of the market participants actually who are handling bonds think of it as more like around the 35 to 50% between May and June in terms of lowering the rate.
All right. With all these uncertainties, I believe we would just have to wait and see. All right, well, Professor Sei-wan, we also need to take a look at South Korea's inflation. Seoul's inflation did fall below 3% for the first time in 6 months in January, but grocery prices, including for fruit, are still very much high. Could you tell us more about this figure?
Compared to U.S. inflation, we have kind of different situation in Korean inflation. Korean inflation slowed to a 6-month low in January this year. The January inflation stood 2.8%, higher than the same month the year before. In previous month, which is December 2023, the annual inflation was 3.2%. And in January, the core inflation, which excludes volatile food and energy items, rose 2.5% on year. This is weaker than a 2.8% rise in the previous months. And actually, it is the weakest since December 2021. So we can see that Korean inflation is significantly weakening recently. But there are some concerns because this slowing inflation is related to slowing Korean economy. This year's Korean economic growth forecast is only 2% level, which is not enough to recover last year's economic recession. And also, there is a high possibility that Korean inflation might rebound to 3% level anytime as the geopolitical situation in the Middle East is driving up oil prices and domestic agricultural products prices rise.
Right. As our Professor Sei-wan already mentioned, Professor Hwagyun, with uncertainties in the Middle East, many worry that unstable global oil prices could accelerate inflation yet again. Now, how worrying is this? Could you tell us more about this?
I think it is a valid concern. And also, these are the biggest oil producing and exporting countries. And it's probably not as important for the U.S. inflation, but for Korean economy, because the Korean economy relies a lot on the Middle Eastern countries, the oils for many of these businesses. So I think that's probably a concern. Of course, the silver lining is nowadays the oil supply is quite diverse, I think, in terms of the supply sources. So usually whenever that happens in terms of like some instability, then the U.S. and some other countries start increasing the oil supply. So typically the duration is relatively short. And also core inflation usually just excludes the energy price because it's just too volatile, which basically means that it's going to be relatively temporary. But I think it can impact some businesses at the margin, or especially who are actually somewhat in small scale. So I think probably the Bank of Korea has to look at closely about that in just measuring their, the timing of the interest rate changes.
All right, I see. So though we have diversified sources for the supply, it is indeed a valid concern. And to curb this potential inflationary pressure, Professor Sei-wan, just several hours ago, the finance minister announced the extension of the tax cut on fuel consumption by an additional 2 months. Now, how do you see this? Was this a proper measure?
Well, Korean government extends fuel tax cut temporarily in every 2 months from last year. Except today's extension, most recently, government extended tax cut on auto fuels by another 2 months in January through the end of February. As we know, it is an effort to curb inflation amid lingering global geopolitical risks, despite recent declines in international oil prices. Since international oil prices pretty much stabilized at $80 per barrel level, and inflation is also relatively stabilized, as we talked about so far. Korean government can finish fuel tax cut in sooner or later, but there goes something very sensitive issue, actually political issue related to the fuel tax cut extension. This time, the political situation that we have general election in April would help to extend the fuel tax cut for 2 more months. Also, the fact that oil prices could always turn higher abruptly makes Korean government to extend the fuel tax cut to decrease economic uncertainties of households and firms. However, in the long run, it would be difficult for Korean government to extend fuel tax cut continuously because government is suffering from tax revenue drop from last year.
All right, I see. All right. Well, Professor Hwagyun, we are going to make a forecast on what decision BOK is going to make. But before that, I'd like to also talk about the growth outlook. The Korea Development Institute on Wednesday kept Korea's growth forecast unchanged at 2.2% for this year. However, it added that it would be very much difficult to expect a recovery in private consumption. How concerning is this?
Well, I think probably today's theme is mostly about uncertainty. So I guess even KDI has difficulty forecasting, the economic outlook, especially related to consumption. So, I mean, there are a lot of situations going on. And also at the same time, political situations also changing a lot in that, like elections coming up. And usually around the election, government and also the other parties actually try to just really give more positive signals and then try to make more like, optimistic, policy, changes and things like that. So it's all kind of mixed up. So KDI's models, predictions, because I have several students who got, the doctors actually from my guidance, and actually they're working in the KDI and they're pretty good, but I'm sure that they're, the forecast actually have very insignificant results. So they're actually not very confident about what to say. So maybe that's actually why. So for the time being, I think we have to still gather more data and see what happens. But the sentiment clearly is not very high. I can see that. And I recently read an article, and then the rate of the restaurant closure nationwide seems to be the peaking this year. And it was about like 10% last year. So I think clearly there's some concerns.
All right, I see. Well, up till now, based on our discussion, it seems there are so many factors to consider. Professor Sei-wan, what might be the BOK's decision at its upcoming rate-setting meeting?
I believe Bank of Korea will leave its key interest rate at current 3.5% in coming interest rate decision meeting next week. Since Korean economy's growth momentum is pretty much weakened from last year, there are many reasons for Bank of Korea to cut its key interest rate below 3.5%. Last year's economic growth was 1.4%. And as Professor Kim pointed out, this year's economic growth is expected to be about 2.2%. And the need for additional rate increase has been reduced as inflation continues to slow and risks related to international oil price and overseas risk like Middle East crisis have been weakened too. But at the same time, Bank of Korea has reasons not to cut interest rate. Lower interest rate might cause many other problems like stimulating an expectation for real estate price increases and therefore household debt increases. Also, lower key interest rate of Bank of Korea increases the interest rate gap between U.S. and Korea, which is 2% as of now. When the base interest rate gap increases as Bank of Korea cut its key interest rate, there can be problems in exchange rate control and capital outflow by foreign investors. So I believe that Bank of Korea would cut its key interest rate after seeing Federal Reserve interest rate cut.
All right. So for now, Bank of Korea is highly likely to keep the rate and then see how it goes in order to begin the rate cut. All right. Now, shifting gears a bit here, Professor Hwagyun, the EU regulator decided to give a conditional nod to the Korean Air and Asiana Airlines merger deal. What is this about? And I hear this would eventually be beneficial to low-cost carriers such as Ewha Air. Is this right?
Yeah, that's what I read, and the EU's conditional approval of this Korean Air and Asian airline merger is like a big step, of course, in terms of consolidation of the South Korea's aviation market, obviously. And this decision, I think, is, of course, the contingent on the Korean Air's kind of divesting certain assets, especially the Asiana's cargo business and some routes actually to the Ewha Air, which is a South Korean low-cost carrier. So I think that's basically kind of Korean Air's proposal to remedy this type of the European Commission's request because they're worried about antitrust and anti-competition issues. So I think the divesting routes to the Barcelona, Frankfurt, and Paris and Rome, and by surrendering them clearly to Ewha Air, I think they can actually, these low-cost carriers actually can some benefit in terms of the expanding their routes to other countries and therefore increasing the competition, I think. So that's kind of the context that you seem to be asked about.
All right, thank you for your context explanation. Well, Professor Sei-wan, so the proposed merger has received approval from 13 countries so far, including the recent EUs, and now is waiting for the final approval from the United States. How do you see this going?
Well, there are some mixed expectations about gaining approval from U.S. government in merging Korean Air and Asiana Air. The merging between Korean Air and Asiana Air faces with virtual final hurdle of receiving approval from United States regulator. Previously, Korean Air and Asiana Air have received approval for their merger from Japan and EU's competition regulator. This means that, as you talked about, they received approval from 13 out of 14 countries that can give approval. But predictions are mixed on how tough U.S. Will become about giving approval on this merge. Basically, this merge is on issue of weakening competition in global air travel market, as Professor Kim pointed out. And therefore, U.S. government can be strict on this issue because U.S. government has been historically more strict about private corporations merging for stronger market dominance. But there are quite a few positive factors to get approval from U.S. government. U.S. government has an aviation liberalization agreement with Korean government, which allows Korean airlines to operate services to U.S. territory without serious negotiation. So many experts have fewer concerns about gaining U.S. Approval.
All right. Well, based on what our Professor Sei-wan told us, it seems it could be quite tough to get this final approval from the U.S. And it could take some time to get through the entire process. However, Professor Hwagyun, if the merger deal is finalized, what would it mean for Korea's flight industry?
Overall, I think the industry is going to have some good, news. Although I think, the one potential concern is because it's so big now, it's basically just one large company with some low-cost carriers. I think that's going to have some issues in terms of like monopolizing this business, and then especially with the airfares nowadays surging because of inflation. If they're monopolized, I think the price is going to go potentially like even higher. So I think that's the concern. But in terms of overall, the profitability, because the flip side of that is like the Korean Air, Asian Air will have some good windfall of like profits. So I think profitability is going to increase, and they probably can better compete with other large carriers like in worldwide, such as like American Air and Delta and then other places. So overall, I think it's going to be a good thing. Similar to banking industry, I think this one actually really needs big fixed cost investments. So I think the large, the size actually helps. But in terms of the antitrust concerns and also a little bit of like this inflation worry because of the airfare surge, that's kind of something that, even if the merger deal actually worked, both the industry and the government have to think a bit about that.
All right, I see your point, Professor Hwagyun. Now, unfortunately, this is all the time we have for today's edition. Thank you, Professor Hwagyun and Professor Sei-wan, for your time and insights today. We really appreciate it.
Thank you very much.
Always my pleasure.
All right, that's all for Within the Frame tonight. Thank you for watching, and goodbye.